Welcome back to the Layman's Globe. Today we're bringing you a fact-checked explainer, completely fluff-free, to make sense of one of the most wild market events in recent history, the SpaceX IPO. We're going to unpack the hard, audited numbers behind all those massive headlines you've been seeing.
So let's dive right into this paradox, because honestly, at first glance, the math just doesn't add up. On one hand, you've got this incredible technological pioneer, right? But on the other, you have financial realities that totally defy traditional logic. I mean, how exactly does a business losing billions of dollars a year convince the global market to value it alongside the most profitable tech giants in history?
Well, to figure that out, we got to start with the basic mechanics. When SpaceX went public, they priced their base IPO at $135 a share. You multiply that by over 13 billion outstanding shares, and you get an equity valuation of a staggering $1.77 trillion. Now, keep in mind, an IPO valuation is really just the price buyers and sellers agreed on that specific day. It's not some certified auditor's number.
Yet when we actually pull back the curtain and look at their audited financial statements, their 2025 revenue was only $18.7 billion. Okay, to be fair, that revenue is growing at a super impressive 33% year over year. But guys, $18.7 billion is a tiny, tiny fraction of a $1.77 trillion price tag. It shows us that investors are paying massively upfront for what they think the company will become down the road, not what it actually is today.
And here is where it gets even more shocking. On that $18.7 billion in revenue, they actually reported a consolidated net loss of $4.94 billion for 2025. They are spending incredibly heavily, burning through over $20 billion in capital expenditure alone that year. This basically means there isn't even a meaningful price-to-earnings ratio for us to calculate. Traditional valuation metrics just completely break down here.
So, Section 1. What are investors actually buying? Let's look under the hood of the SpaceX economic engine.
Looking at the actual audited breakdown reveals a pretty massive surprise. You see, the space and AI segments are actually losing money. Space operations saw a loss of roughly $657 million, while the AI segment burned through a massive $6.35 billion. It turns out, the Starlink connectivity platform, which generated a $4.4 billion profit, is the sole engine keeping this whole ship afloat.
The really crucial takeaway here is that investors are primarily betting on a rapidly compounding, high-margin global connectivity network. They're not just betting on a trip to Mars. Starlink produced roughly 61% of the total revenue and literally all of the group's operating profit. It's bringing in recurring subscription revenue with an operating margin of around 39%. That is the fundamental bedrock holding up this entire narrative.
Moving on to Section 2, let's compare SpaceX versus Reliance Industries. Apples, oranges, and massive expectations. Just look at the stark contrast here to put things into perspective. Reliance generated $113.6 billion in revenue and earned a massive $10.1 billion in net profit. Meanwhile, SpaceX had a fraction of that revenue and, as we saw, a nearly $5 billion loss. Yet despite Reliance generating roughly 6 times more revenue, the market went ahead and valued SpaceX about 9.3 times higher. Crazy, right? This creates a totally jaw-dropping valuation multiple gap. At the IPO, investors paid 94.5 times sales for SpaceX. That is roughly 57 times more per revenue dollar than they paid for a mature company like Reliance. A gap of 57 times can really only be defended if investors are absolutely banking on stratospheric future growth and a complete vertical monopoly. The absolute best way to wrap your head around this is to think of Reliance as a massive, highly profitable supermarket. It sells vast amounts of goods today for solid, predictable profit. SpaceX, on the other hand, is being valued like a global toll road network. Investors are paying an astronomical premium today simply because they believe they're securing a monopoly on tomorrow's orbital and digital traffic map. They want to collect those digital tolls for the next 50 years.
All right, Section 3. Is Elon Musk a trillionaire? Let's talk about the reality of paper wealth versus actual spendable cash.
This brings us to the loudest, most click-worthy headline from the IPO. Following the offering, the prospectus disclosed that Elon Musk holds just over 6.06 billion Class A and B shares. Now, while Class B carries stronger voting power, both classes carry exactly equal economic rights, meaning they convert one-to-one for valuation purposes. So if we do the math and multiply those 6.06 billion shares
by the June 22nd market price of $165.15, which was a snapshot where the stock had surged past the IPO price, his gross stake hits exactly $1.002 trillion. So strictly speaking, the math does work.
But we have to remember, this is standard mark-to-market accounting. It's a purely theoretical value. So calling him a trillionaire is technically defensible, but assuming he just has $1 trillion of spendable cash sitting in a bank account is completely false. A highly concentrated, locked-up stake like that cannot be sold instantly without triggering massive taxes and severe market impact. Honestly, a single volatile trading session could erase that title entirely.
Which leads us to Section 4, the 3 realistic paths and what exactly must happen for this valuation to hold.
Because a $1.77 trillion price tag leaves literally zero room for disappointment, there are really only 3 realistic paths forward here. Path 1, for the bulls to be right, fundamentals must catch up perfectly. Starlink compounds, Starship succeeds, and AI monetizes. Path 2, if business improves but just not fast enough, we get a time correction where the stock basically moves sideways for years. But Path 3, if there are major delays or stiff competition, expect a sharp price correction, heavily compressing that massive 94.5x multiple.
If you want to know which path SpaceX is actually on, you've got to ignore the hype and watch these underlying metrics. Keep a close eye on whether Starlink can actually maintain those 39% margins. Watch if that $6.3 billion AI loss starts to shrink. And most importantly, you need to watch if their massive $20 billion in capital expenditure actually translates into repeatable, lower-cost Starship operations, or if it just remains an incredibly expensive experiment.
Ultimately, a great company and a very demanding entry price can totally coexist. SpaceX undoubtedly owns exceptional, really hard-to-copy assets. But at the IPO, investors simply paid in advance for most of the success that SpaceX still has to deliver in the 2030s. So the question I'll leave you with for this explainer is this. In a market that's pricing in absolutely perfect execution, what exactly happens to the toll road if the traffic arrives just a few years late?